Okay, all right. So today we are taking a standard called IAS 8, which is called accounting policies, changes in accounting policies and accounting estimates, and error and prior period error. So I know. Yes, I'm recording. So it's the standard is called IAS 8, which is called changes in accounting policy, estimate and prior period error. So according to in accounts, there are some errors that occur whereby in the period that is not in the current period, maybe in the period before now, and then maybe you want to adjust those period. So this standard actually teaches us on how to go about making those changes. That is one. Also, it helps us to do what is called to understand what an accounting policy is, what accounting estimate is. How do you know this is an estimate? How do you know this is a policy? So then it helps you to know exactly how to go about carrying out all of these processes. So I'll start my slide. So introduction to IS 8. IS 8 provides guidance on accounting policies, estimates, and errors, like I said. So it ensures comparability and reliability of financial statements. So now the reason for this standard is that this standard is just going to um, the essence of IS 8 is to make you understand to bring about reliability and then comparability of financial statement. For example, if we have, let's say, last year, your figure is, let's say, in your income, your figure is £50,000 in your income, and this year, your last year, your income is £50,000 and your cost is £20,000. So you have a gross profit of what? Of £30,000. Then some of those goods that you actually bought last year, in let's say you bought some goods which you classify as your fixed assets, or you actually bought some goods which are like cost to you, then you supply those goods to your customer. So you supply those goods, if you supply those goods to your customers and your customer then decide to return those goods to you, or you couldn't sell those goods to them as at the end of the year, or maybe when you ship the goods to your customer, you know, the goods wasn't delivered until maybe the next following year, maybe 31st December is the year end, and then you deliver those goods, you ship those goods maybe like 28th of December, and then your delivery term is that maybe when they receive goods when you recognize revenue, but you had recognized revenue when you shipped up that goods, and then in the following year, which is 2nd of January, the customer then said, "Oh no, this goods was not received by us in December. Therefore, because of that, we will not be taking these goods again. We are going to be returning these goods back to you." Don't forget that already in your account for the year, you must have recognized income for that goods you've sold in that financial year up to 31st December that you recognize in your account. So those goods you've recognized already, it means that because the customer has rejected that goods that you supplied to them, they did not take that goods from you in the following year, and you already the year before you had recognized income in your account. So you need to reverse that income, because if the customer don't recollect, take that income, take that goods from you, which means you've not made any sales, right? And if you haven't made any sales, then you have to reverse the income from your profit or loss accounts. So this standard will actually show us how to go about doing all those things. And then because the basic need of this standard is to just show us that financial um, financial statement can be reliable and and can be comparably checked together with prior year. So the next one is talking about the principles. That's policy. Principles are what are principles? Principles are policies, rules, and practices used in preparing financial statements. When I say FS means financial statements. So when you hear the word policies, policies here refers to principles, rules, and practices that is used in preparing the financial statements. Then when you hear the word materiality, materiality means misstatements or omissions that are material if they influence users' decision. For example, when we say something is material, if they influence users' decision, for example, if you sold a good, like I made that example, and the good is 50,000 and the good is £20,000 you've sold, and your all of your profit is £10,000, you know that income, that good you sold that come as income, is it material or not? Can someone answer? If you sold a good of £20,000, and then at the end of the day in your P&L your profit is £10,000, at the end of after taking out everything, your profit is £10,000. That good you sold, is it material or not? Can someone tell me? If you sold goods, for £50,000, and then the goods was returned, like I said, And then, but before then, the goods was returned in the following year. Then, but you sold the goods in this year. You sold the goods to someone for 20,000 pounds this year. But next year, January, the person returned the goods saying that no, the good didn't come to us on time, so we cannot take these goods. It's gone off our book. So, and then you already declared the profit in your financial statement this year, a profit of 10,000 pounds at the end of the year. Would you would that 20,000 goods that you sold that was returned back to you, is it material or not? Exactly. Exactly. So exactly. That's why we have the IAS 8, which is called the changes in accounting policies and estimate, to look at some of those areas. I'll be coming up with different examples but I just want to explain the concept to us first so we understand the concept of IAS 8. And I know some of us already know it, was just like a refresher to some of us. Or some people, it's just like understanding it like from the core principles. So I like people like David, people like Samuel Faye, people like Opele, Mr. Opele to ask questions, and people like Ms. Adejoke to ask questions where they are not clear as I go on with this topic. So I'm going to talk about selection of accounting policies. If now in accounting policies now, so how do we know that this is something an accounting policies? According to IS 8, according to the International Accounting Standard Board, ISB, and IFRS, when you know it is a policy, an accounting policy, is that if it meets two rules, and those two rules are: one, if the IFRS, if IFRS covers the issue, that means if the issue is covered by IFRS, then you know it meets that rule. When I mean that, I'm going to explain that to you shortly. Then the second one is if no IFRS rule or judgments. For example, if there are no rules to it. But before I go to that, let me just explain the first one. So, for example, if there's an IFRS rules covering that issue, then you need to apply the relevant standard. For example, if you're talking about, let's say, maybe there's an issue with your income, like I did explain that you sold a good to someone in 2024, right? In 2024 December, and then January the goods left in 2024 December, but got to the place by ship and got there late, got there 2025 January, and then they returned the goods back to us that they don't want that goods again. Don't forget that we already recognized income in our books for that figure. So therefore, because we recognize income for in our book for that figure, and that goods is being returned back to us, there's a standard in IFRS that covers that, because obviously the goods was returned. So there's what we call IFRS 15, right? We were talking about this on Saturday, that covers that area of when you're selling goods. And I also sent the Incoterm to us, which talks about the Incoterm. We have the X works, we have the different kind of Incoterms, the DAP, and all of those Incoterms. So if your Incoterm for selling those goods was, let's say, as they returned it back to you, and then you recognize income, then you have to use the IFRS 15 to undo that particular scenario. That is what is meant by if IFRS covers the issues, apply relevant standard. I don't know if that's clear. If IFRS covers the issue, then apply the standard that it covers. For example, if it relates to goods that you sold, then it means definitely to be eating IFRS 15. If it relates to, let's say, you that bought the goods, it is what will it be to you in your books when you bought the book, when you bought the goods? It will be an inventory, which means it covers what? IS 2. I don't know if I'm making sense to you. The person who bought the goods, in the person's book, it will be IS 2, which is inventory, while the person who sold the books, while the person who sold the goods, in the person's books, it will be what? Income, because they've sold goods. So they've received, they are expecting income in their account, so they've recognized income for that year, while the person who is receiving the goods is going to record it in their inventory. So the account standard applies where there's an account standard that applies, then you can apply that standard, saying, okay, in line with IES 2, this is what we are going to do, and this is what we are going to do. In line with IFRS 15, this is what we are going to do, this is what we're going to do. So that's how that standard comes into help in this scenario. But in a situation whereby there is no IFRS rule covering that area, then you have to use your judgment to ensure that the information is one. For you to use your judgment, you must ensure that also two things. One, the information must be relevant to the user's needs. So, and also the information must be reliable, it must be faithfully represented, and it must have substance over form. So what I mean by this is that now, if you're talking about you returning a goods, for example, and a good that was supplied worth 20,000 pounds and then was returned back to you, and you know you recognize income already for that goods, you recognize income in your book. So if that goods was returned back to you, you know definitely that that thing is material. So then think about it. Is it relevant to users' need? I don't know if someone can answer that question. Is it relevant? 20,000 worth of goods was sold, and then this was returned back by a client the following month, and we already recognize that in our book already for this for the month at the end of the year, and it's in our financial statement. But that goods was 20,000 that was returned. Do you think it's relevant to users' need? I'm just giving that example. Are we there? So I said a goods was sold for 20,000 pounds in 2024 as at December. Then in 2025 January, the goods was returned, saying that because the goods didn't get to them on time, so they returned the goods back to us. So that goods that they returned back to us, we had recognized income for that goods in our book. We've done credit income, debit receivables for that transaction. Now, because they returned the goods back to us in the following year, we know it will require a change in account. You know it's going to be like we need to adjust that in our books, right? So I'm now asking that in such situation, that is it relevant to users' needs? When I use the word users, who are users? Cassandra, can you tell me what I mean by users, please? Not consumers, no. So the users are the shareholders and the public, people who use the financial statement. Yes, thank you very much. People who use financial statements in the public. For example, you and I, we are the users. Shareholders are the users. Research institutions are the users. When you hear the word users of financial statements, those users are the public, the shareholders, the government, the anybody who use this financial statement to that who relies on it to make decision. For example, you know, some people just look at the shares of Tesco or shares of Dangote to make decision in their company. So if, for example, Dangote profit goes down, they're like, oh no, something is wrong here, and they make decision based on that. So those are the users of the financial system. I don't know if that's clear. I don't know if that makes sense. Okay, so I'm just trying to give explanation saying that if there are no rules by IFRS for those, then the relevant users, we need to look at the two things, which is that is it relevant to the users before we can say we are making any adjustments, and also is it reliable, does it faithfully represent, and is there any substance over form? So that's just that part of it. So when can we say a change a change in accounting policy? So let me explain something to us before we go on with all of this. So what I'm talking about changes in accounting policy and accounting estimates. So there are two things I'm talking about here. I know people who didn't do accounting would not understand what I'm talking about. So let me explain it. Let me really break it down. Okay, I want to say something. Okay, okay. So substance over form is just talking about more of relevance and putting things that are not relevant in. For example, you can be doing your FS and be putting a lot of junks in it that does not really make sense into it. So those are like it does not meet substance. It does not. It doesn't meet substance over form because if you are making an argument, for example, and then that argument does not really make any meaningful sense, then it does not meet substance over form. I don't know if you get what I mean. So I want to just break it down for that before I go forward. I don't know, most of us might not understand what we mean when we talk about I have a definition for substance over form. Let me just give it. It says the principle of substance over form means the transaction and event should be recorded according to the economic reality. That's the substance, rather than just legal form of it. I don't know if that is clear enough. I'll drop that on the chat. Let me pick the chat. Sorry, just want to drop it on the chat. Substance over form. Meaning, just type in it. Right, I've dropped it on the chat. So now, as while we go on, so I just want to explain the concept of changing accounting policy and change in accounting estimate to us. So before we go on, when you hear IS 8, basically IS 8, the standard is not a big standard, it's a small standard, right? So let's forget about the old grammar and the old rubbish I've written down on this page. When you hear the word IS 8, what should come to your mind is three things. One is changing accounting policy. Two is changing accounting estimates. Three is prior error prior period error. So what is the first one? Changing accounting policy. I'm just talking off my head now, so that I don't just go by all of these grammars. So when you hear the word changing accounting policy, it means that something has changed, and that thing that has changed would require an effecting of that change in the financial statement, taking it backward to a particular period where that thing occur. For example, if a staff commit, let's say, what example can I give on that? If, for example, you change I'm going to give examples on that anyway. If you change your depreciation policy now, for example, from let's say let me look for an example that is more friendly to all of us. um what example can I give? Let's say, for example, someone, I'm thinking of an example that can require a change in policy. um mm, Okay, while I go on, I'll pick one of my examples here to explain to us. So when we talk about changing account policy, something that will go backward anyways. I'll go backward. You go back, you take step backward to go from the date that change occur. So if a change occurs in 2023, if something happened in 2023, for example, if you've been recognizing, let's say, your depreciation now, let me use depreciation. It might not be so friendly with us for now, but let me just use the word. Let me use depreciation. If your depreciation policy um, is to recognize an item using, let's say, 15 years, and then you then you then decide to change. Let me ask you that question first. If the depreciation policy rate is being changed, that's the years it's been changed. I want to ask people who are accountants, is it a change in policy or change in estimate? If a depreciation policy is being changed, I've used the word policy already, so I've answered the question. I've used the word policy already, so I've answered the question. Don't worry. So I was going to ask us before I go on. I've already used the word policy already. So now, if let's say depreciation now you used to depreciate for, let's say, 20 years, and then you decide to change that. Oh no, these assets, I want to, change the depreciation. I want to reduce it to, let's say, 10 years. And already, don't forget that you already started depreciating. Let's say from 2010 you bought the assets. You've depreciated from 2010 or 2020 you bought the asset. Let's say 2020 you bought the asset. Then you depreciated from 2020 to 2025. You've taken what, 5 years depreciation on the asset. Are we clear on that? And whereas the asset is meant to stay for 10 years. So if the asset is 50,000 pounds, let me bring up Excel to explain this, please. So I don't just talk without showing us what I'm talking about. Sorry, my Excel is coming up. Okay. Can you see my Excel, please? Can you see my Excel, please? Okay, so if you, let's say, you have an asset, let's say it's called furnitures and fittings, and then it changes. Furnitures is always one, is a singular. Furniture can never be furnitures, right? Furniture and fittings will have s. So then if it's 50,000 pounds, for example, right? Oh, I've done something there. Okay, 50,000 pounds, and we want to depreciate it for 10 years. Depreciate for 10 years, right? For 10 years. Hmm? Right? Now, what depreciation every year will be what? We don't have scrap value. So it will be 50,000 divided by what? 10 years, right? So every year will be what? Will be recognizing 5,000 pounds, right? Are we agree? Are we clear on this? Hmm? Then we'll do what? Credit what? Credit. We'll credit what? We'll credit assets, right? Yes. Then debit what? Debit what? Why are we debiting? Eh? Why are we debiting? depreciation expense P&L. So every year we will do this. So let's say after 5 years, we bought assets was bought, but in this is the best way I will explain that you just get it once now. Asset bought, so I want to pay attention in 2020. With this, I believe you get it. You won't you get it straightways. So I said bought in 2020. So we are in 2025 now. So let's assume we've taken 5 years, which is 5,000, right? Times 5 years, right? We've depreciated 25,000, right, of this asset, fully depreciated. Then the company now made a policy saying that, oh no, this asset is a very good asset. We think that this asset would not be would not use sorry, I'm seeing something on my screen popping up. What's this? Hello, can you hear me? Okay, I'm coming, sorry. Okay. So can you see my screen back? Can you see my screen back? Can you see my screen, please? Okay. All right. So now, so let's assume this depreciation now. We are not saying that okay, we have 25,000 pounds for our depreciation now. So as we have 25,000 pounds for our depreciation now, so we're now saying policy now came and said that oh no, that we are not using this depreciation for 10 years again. It's going to reduce to 20. It's going to increase to 20 years because we feel like this asset can stay longer. That management feel like this asset can stay longer. That this asset cannot stay that 25, if we do 10 years, then that is 2030, we will still have this asset more, and we feel like we can still take more. So we therefore want to increase the years of the decision to, like, let's say 20 to 20 years. We're increasing to 20 years, so we're increasing by, right, by additional 10 years, right? So I want to ask us now what has happened here. We've taken already 25,000 for 5 years depreciation already. So what we have left for the depreciation is 25,000, right? Is that clear? Which we've not taken for the remaining 5 years. So now management wants us to increase it by 10 years, another 10 years. So can you tell me what has happened here? Is it a change in policy or change in estimates? Who can answer that to me, please? Who can answer that to me, please? Why? Eh? Yes. Hmm? You said what? Okay. You change what? Sorry, can you go on? Go on. Okay. Okay, so Mr. Abel thinks it is a change in policy, right? Okay, estimates. Okay. Well, who else think is estimates? Who else think is estimates? Who else? Okay, so who thinks it's policy? I'm not. You think it's policy, right? Eh? Okay. Who else? Sandra thinks it's policy. Mr. Opele, what do you think it is? Policy. Okay. Who else? David, are you there? Joke, are you there? What do you think it is? Hmm? Hello, David, are you there? What do you think it is? So what do you think it is? Okay, that's fine. So, I'm happy to tell you all that this is a change in estimates, not a change in policy, because the pattern of consumption has not changed. It's talking about looking at the pattern of consumption. So if we look at based on IES 8, when you change useful life, it's just a change in policy. It's a change in estimate. But however, I don't know if that has been able to explain that angle for you now. So there are three things in IES 8. One is what? Change, change in what? Policy. Then we have change in what? Estimate, right? Then we have change in what? Sorry, we have prior period error. So it is a change in policy if it affects the level of consumption. So as defined by IS 8. So it is a change in accounting estimate because look at it. They've said they're using this asset for 5 years, right? If we go back, if you look at it, they've taken 25,000 depreciation already for 5 years. Now they've changed the years from 10 years to 20 years. All we need to do is just say additional 10 years plus the 5 years. It will become what 15 that they have more. We just need to readjust the assets from this year and say equals 25 divided by what 15, and then we move on to depreciate again. So that is a change in estimates. So, which means what have I done? I've done what? I've done a prospective change. I don't know if you get what I mean. I've changed it prospectively. Eh? I've changed it prospectively. You people agree with me? Eh? Do you agree with me? Okay. I know Aminat, you said it's a change in policy. I understand. Sometimes we tend to is for some of these standards, we tend to forget some of these standards. I know Sandra too said the same thing, and Opele said the same thing too. So there's a change in only Mr. Abel got it. I'm sure Mr. Abel must have peeped through my screen, or he probably knows it. Mr. Abel, why did you get it? Eh? Yes, 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 yes. Yeah, you're very correct. So it's a change in estimate. So when there's a change in estimate, what do? We apply the prospective application to it. So when I use the word prospective application, what do you think it is? Prospective application means from the date that thing happens, you change that thing and you move on from that date. You don't go back and adjust it. So you can see that when I change year in 20 what? 2025, right? 2025, depreciation, depreciation increased, right? Increased to right 50, to 10 years. Mm? So we now have 10 plus, we now have 10 plus 5 equals 15, right? Mm? Equals 15, right? So that's what we now have 15 years. So at that day, 2025, we just make our change straight and we go on with it like that from that date. But now, if we're changing our distinct depreciation policy from straight line method mm, to reducing balance method, that is a change in policy, right? Do you agree or disagree? Do you agree or disagree? Sandra doesn't seem happy. Okay. Okay. So because if you look at it truly, now if I have 10 years, let's do the same asset of 50,000 for 10 years, right? Now I've depreciated for I say I'm going to depreciate for 10 years for 5,000 per year. And I got 2025, we suddenly say, oh no, we want to change to reducing balance method. It should not make sense for us to start saying, oh, we start from 2026 and then say 2026. So we then say equals 25,000 divided by 5 years, right? Eh? And then say we have 5,000 and then say equals 20,000 minus 5,000, right? That's reduced balance method, isn't it? My 5,000, my 5 my bracket close. Then divided by 4 years, right? It will not make sense to do this. What have I done here? 20,000 minus 25,000 minus 5,000 years divided by 4 years. Then that gives us this. Then do the same thing again. This minus this and so on and so forth. It does not make sense to keep doing that because you've then cheated the asset, because what you've been recognized before will not make sense. Because imagine if we have an asset of, let me use an asset of, let's say, of 200,000 pounds, and then you've depreciated for, you want to depreciate for 10 years for, like, let's say let me use 5 years, which would be easy. For 5 years for like 40,000. So our first year we put in our book 40,000 in our P&L, right, as debit, which reduce our profit largely. Then because we decide to see that, oh, in 2025 we are not making a lot of profit. You know how it could be termed like that, because it could be possible that in 2025 we're not making profit, and we then decide that, oh, let's change the policy, let's change the depreciation the way we want it, say, because we're not making profit, let's just change the depreciation policy to say, okay, in 2025 for one, reduce it to reducing balance method, so that at that way it will be reducing our balance more and more and more and more. So in that way it will not really make sense, because we are not showing consistency in what we are doing, because we are manipulating the accounts. I don't know if you agree with that, because if you look at it truly, in 2020 you think you're making a lot of profit, you want to use straight line method, but suddenly you feel like, oh, we're not making profit, so let's just reduce it, so using balance method, and start using this using balance method to do your depreciation. Then at that point you are not showing consistency in the level of consumption, because the way the asset is being consumed, you are not showing the way it is being consumed. So in therefore, what we then do is you then go and apply what is called retrospective application of it when it comes to accounting policy. Retrospective application. So what I mean by retrospective application is that you are going back to restate it as if it has always been reducing balance from beginning. So for example, this asset I talked about now, because we said we are using straight line method to depreciate it, we've done this by this, right? Now if it's using balance method, now we're not going to do it this way again. We'll now have to go back to 2020, year 2020. So we have to go back to the year we bought the asset, 2020, to restate it back. I don't know if that makes sense. We have to go back. I did this in my one of my work recently. One of the clients I'm auditing in Dubai, they used to use straight line method. So suddenly the client said that they want to use reducing balance method, which the group uses reducing balance method when they are doing their depreciation. The group uses reducing balance method. But however, the UK company does not use reducing balance. They use straight line method. The UK company use straight line method, while Dubai uses reducing balance method. So, but now EY is the group auditor in Dubai. EY says no, we want you guys to put reducing balance method to balance to merge with the group policy, and that's also what the group also wants. So I had to now help the client technically. Don't say I said so, to prepare a depreciation schedule. Okay, let's say the client prepared it and I had to redo my own in a different way to show that they actually did the right thing. So what I did was that I went back. Some assets were bought in 20,000, some were bought in 2015, some were bought in 2010. I had to go back to those assets and I had to apply retrospective application as though it has always been done using reducing balance method. So that is how we apply. So instead of me doing straight line method, doing this divided by 10, I'll be doing I won't be doing it like that. I'm taking it down, down, down. Like, no, I only do year one. So let me show you how to do it. Let me just use for 5 years, for example. It will be year one. I thought I already showed you guys this already when I was in Excel using balance method, so I won't be doing it again here. So year one, I'll just do this, take my first depreciation, which is divided by 5. I'll then say equals 200 minus what? Minus 40,000. So now I have what? 160. So I'm not going to apply the same thing again. I'm not going to say equals 160, then 160 divided by what? Divided by how many years is left? 4 years, right? 4 years. I'll be going like that. I'll be reducing balance like that until I get to zero. It's going to be reducing balance method like that. I don't know if that is clear. So I have to go back to the beginning of the year to do a retrospective calculation of the assets. So I don't know if you got that's if you got that clearly. Change in accounting policy is retrospective application. Change in accounting estimate is prospective application. When there's a change in accounting policy, you go back and apply it from the year that that asset existed. That's what it means. So if you change the policy in 2025 and then you bought the asset in 2020, you have to go back to 2020 to go and change that policy to meet up with what has happened. If it was a change in estimate, like I said, which is useful life, you just start from where we kicked off from. You can see when I add 6,000 plus 1,600 from like that on the assets, and then we move on like that. I don't know if you got that, please. Can you give me a thumbs up, or if you have any question, let me know if I move on, please. Okay. Hopefully has a question. Go on, sir. Okay, fine. Okay, all right. Sandra is clear, right? Omoife is clear, right? Okay. So I'll move on. I've already talked about. Okay, so yeah, a change occurs when recognition. Okay, so yeah, I said so. There are changes. Change occur when it is only permitted by. So when you say it's a change in accounting policy, it's a change in accounting policy only when it is recognized by the IFRS, like I said, and it provides more reliability and relevant information to the users of the financial statements. Who are the users? Don't forget you and I, the public, the government, every other person who uses financial statement, the shareholders, not the board of directors. They are just the preparers, are not the users. The users are the shareholders, the public, the government, prosecutors, everyone in the public uses the financial statements of a company. So a change occurs when recognition, measurement, or presentation of an item is altered. Can you see when you alter the way you measure, the way you recognize, or the way you present an item, then a change has occurred. For example, if you were not if you have a, if you're supposed to be paying your pension and you're not paying your pension regularly, that happens. I'm giving you everything I'm giving you here a real life situation that has happened to me when I'm working as an auditor in the UK here. So everything I tell you today are things that I know that I've come across as experience, real life experience. So if I was auditing a company, the company I was auditing does not, they don't recognize pension for their staff because the person is a MD, is a director, and he wants to take his pension through bonus. So they've not been recognizing it. So when I started auditing that company, I had to tell them that no, we have to go back to when you stopped recognizing pension, which took us back to like 10 years ago. So when we went back, we then started, and I had to do like a rough calculation. I had to go to gov.uk to check the policies 10 years ago for pension. I put the policy up to when the policy changed. Policy of pension changed from 10 years ago to like 7 years ago. I stopped there. I now move again. What policy again from 7 years ago? Because gov.uk has all the record of all the changes. I move from that record change again to the next change. Go on. Go on. You're not meant to lie. Pension must be paid. Yeah, it must be paid because the law of pension is that you must pay employer and employee pension. Employer has to pay in the UK here it is 8%, minimum of it 8%. Employee has a minimum of 3% to pay in his salary, while employer will pay like about 5%. So employee can start to pay 4%, while employer might pay 4%. Employee might pay 8%. You can do pension sacrifices. So that's for another thing entirely. Let me not go into that entirely. So when I did calculation, I went back and I was changing it based on each changes that occur in the gov.uk site. And I had to do a calculation and show the amount that we will need to go into what's called provisions. So I then asked them, how much are you going to recognize this year? We recognize the amount for this year, which went into current liability. Then the one for the next years, it went into non-current liability. If I could pause my recording, I could show you that account on company's house when I filed the account. You see my provision that I made in the account for them based on my audit adjustment I raised and the one they've corrected in the following year. So I went retrospectively. I went back to the time when they stopped paying pension to apply. So that is what because I'm talking about that when presentation of an item is being altered. They altered the presentation and they were not recognizing the pension. Do you get? That is where it comes in. So you need to then the change has occurred. That's a change in accounting policy. So example of these changes is when you change from first in first out to what to weighted average cost model, or you move to maybe you change to fair value measurement of maybe what am I talking about here? Who can tell me what I'm talking about here? I'll ask accountants here. I mean, that's what do I mean by FIFO? Which standard covers this? When I mentioned FIFO, which standard covers FIFO? Which standard are we looking at here based on what I talked about now? IAS 2. Mr. Moefe, you are hot too. What is happening? Hey, hey. This one is not, you are not even waiting, no. Hey. So when you talk about FIFO, weighted average cost of capital, fair value measurement or change in depreciation, we're talking about inventory for FIFO to weighted average cost of capital. So we're talking about fair value measurements, fair value to change in depreciation. Those are two different things again. So, but they are all changes in accounting policy. So please note them because I have questions for you and which you answer for me. Please note all these things down. FIFO, weighted average cost of capital, cost model, when change from cost model to fair value model. For example, where can this occur? I need someone to tell me this. If whoever gets this, I'll give the person a £10 voucher. I know Mr. Emma does not need my £10 voucher. So whoever gets, I'll give the person £10 voucher. When do you change a cost model to fair value model? Which standard covers that? Not IFRS 13. Don't tell me IFRS 13, no. IFRS 13 is fair value measurement, so don't tell me that. I'm asking for which kind of assets, which kind of standard covers you changing that allows you to change from cost model to fair value model. Can you tell me, please? I have a standard in mind. Don't tell me IFRS 13 because that's fair value measurement. Thank you very much. Thank you very much. I investment. Oh, I owe you £10 voucher. Investment property. So because if you look at it, investment property. Let me not go into it. It says that you can either use a cost model or fair value model. But however, anyone you choose must be consistent, right? If you change anyone, you have to go retrospectively, right, to apply the changes. That's why that's coming here. So that is just a change. That is change in accounting policy. So when there's a change, when you see something, you have to think about it. Does it change the pattern of measurement? Does it change the way it is being recognized? Does it change the way it is being presented? Is it altered? Does it change the level of consumption? If it does, then you have to apply a retrospective application of that item, and it becomes what a change in what accounting policy. Now let's move to change in accounting estimates. So okay, applicable changes. Like I said, you have to apply retrospective application. You apply the new policy as if it has always been applied. Can you see? Retrospectively means going back. So let's like I give this example on that asset I talked about. I said you applied as if that 50,000 asset you bought. You have to go back to 2020 as if it has always been what reducing balance, right? So apply it. You won't apply it as if it's been reducing balance. You won't apply it from the date you change it because it is what you are changing from straight line to reducing balance. So you have to go back and apply it as if it has always been in effect from the date you bought the asset. Even if you like use that asset and that asset has almost been finished, you must go back and restate this in your account. I expect people to ask me some question that how will I do this when my account has been prepared for 2020? I expected that question to come up because if I prepared the account for 2020, if I prepare account 2020, right, and that account has been audited, has been filed. So how do I now go and do this? So I'll move on. Since you don't answer that question, I'll not answer the question. So okay, so yes, yes. I'll answer later, don't worry. Let's go on. So now, yes, you can. You will see the comparative year. I'll answer it, don't worry. When we go on, I'll answer it as we go on. Don't worry. So you adjust the opening balance. Oh, the answer is already here already. So you adjust the opening balances and comparative year, like Amina has actually said. So now what we do is this. Let me open an Excel. Yes, let me open an Excel to show you what I'm talking about. Let's assume that when we did all of these changes now, we realized that our depreciation normally for the difference within all of these things within these years back to 2020, there's 5 years now. The difference is about, let's say, is about £4,000, right? So £4,000, that's the difference, which means we've under depreciated £4,000 in the P&L, and we've also what? We've also what? We've over, right? It will be over, right, for assets, right? Yes, we've overcharged for assets and underrated for P&L. So we now need to now do what is called an adjustment of this. What we then to do is we then do like credit what? Tell me the accounting entry, please. Credit what? Oh, yeah, tell me quick. I know you know it. It should be straightforward. What's the accounting entry? If we under depreciate for P&L and we overcharge for assets, so tell me the accounting entry. Sandra, please. Okay. Okay. Yeah. That's correct. Yeah, then debit assets. Thank you. So debit fixed asset, right? So now, thank you very much. That's what you're supposed to do, right? So now what we then do is we then go and debit fixed asset, but then we cannot credit depreciation expense. So who can tell me we are going to credit and tell me why we are not crediting depreciation expense? Kamila, can you answer that question, please? I want you to just be interactive. I don't want to just give you all the answers. We can't credit P&L for a reason. Sandra is correct, but then there's a reason why you cannot credit P&L. Can Sandra tell me or can Amina tell me? I know I'm calling both of you because you're a child accountant. That's why I'm calling both of you. Of course, this is accumulated depreciation we're adjusting. That's this one. Don't forget. That's accum deep for fixed assets. You get that's what we are doing. So this one will not go to this will go to what is called I'm not can you tell me, can you try before I give the answer? Can you try I'm not before I give the answer? Who can try? Who wants to try? Who wants to try to go to retain earnings? So this is because don't forget 2020 account has been completed. We cannot go back to it. Hmm? 2021 account has been completed. We cannot go back to it. 2022 account has been completed, we cannot go back to it. 23, 24 has been completed, we cannot go back to it. 25 has been completed, we cannot go back to it. It's been signed by auditors. We cannot go and touch it again. What we then do is that we do our calculation live, and then we have to change. We have to now do instead of going back to the P and L, because don't forget that every profit you made and loss you made went to the retained earnings. Do you remember that concept? Every profit or loss went to retained earnings in balance sheet. Don't forget. Hmm? If they went to balance sheet, then you have to adjust only balance sheets because balance sheet is always what at a point in time, not at a period in time like the P and L. P and L is only for a particular period, but balance sheet is for a point in time, which means it is always there for you. You have your balance sheet has your assets and everything and your liability for everything you've had from the date you started your company up to date. But P and L is only for only for 12 period. Don't forget, only for 12 months period. So we cannot eat P and L again because P and L has been closed. We've moved it already. So we now have to assume because if you look at it now, if already this has happened in those years, don't forget that this balance would have been in retained earnings because we'll have done all of this credit. If maybe like year one 300, year two 800 pounds, year three 2,000 pounds, they will have all gone to what the balance sheet under retained earnings. So that's why we are going to create retained earnings once for that balance because that's our adjustment. So this will only affect our comparative what's it called comparative what's it called comparative checks alone when we are doing the checks on them on paper, but in theory comparatively when you're checking like depreciation calculation, let's say depreciation for P&L, you'll see it will have reduced on calculation, but however on the account it will not reduce because it's been filed. But on the account for the new year account comparative, it will be showing that there's an adjustment made and a note to the account. That's why we talk about what presentation of the account. If I go back to it, it talks about what presentation. Can you see it's been altered? Can you see where presentation is being altered, regulation and measurement is being altered? So we now look at the presentation at that point. So you only be changing what you'll be changing the comparative period alone, but however you're going retrospectively to adjust everything and then put in what retain earnings. I don't know if that makes sense to you, or please, I don't know if that makes sense. If it doesn't make, I can break it down further. Are you following me? um Mr. Mo, if are you clear? I mean, are you clear? Sandra, are you clear? Are you clear? Okay, I'm not. Are you clear? Sandra, are you clear? Okay, sorry, you said no. I'm not. You said no. Hello. Okay, she said yes. Okay, so let me move on. Yeah. So that is how that changes is going to be. Although I'm going to give you examples. I have examples to show it clearly. It's going to be very clear to us. So, but I'm happy you guys understand it. So the changes in accounting policy is just it applies the change from the date of the change happen. You know, used for changes in accounting. So it applies as if the change has always been from the date it happened. So the only thing that happens is that we're going to just do like a opening balance adjustment, which I've talked about. We're going to just adjust the opening balances in our comparative period, like Aminat said. Just that, just like 2024, 2025 five account has been done. When we come 2026 now, we'll make those adjustments on our books, but in the opening balances that will be showing to compare 2026, that's 2025, 2026 now comparative, we'll be showing those balances are adjusted. We'll now put notes to explain why those balances are adjusted so that users of financial statement can also actually see and understand why we've done what we've done. That is why that change happens. So prospective change. So when we have a change in accounting estimate, it is a prospective application of the change. So we use accounting estimate for changing prospective application of which means it applies from the date, like I said, from the date it happens moving forward. It has to go prospectively. Mr. Man, you have a question? Go on, sir. Go on, sir. Yes, sir. Dividends. When you say dividend, what do you mean dividends, sir? Dividends are being paid out. Mm. It's not compulsory you pay dividends. Okay, ask your question, sir. Go on. I'll explain. Yes. 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 That's very correct. Yeah. Okay. So let me explain that concept, sir. Beside my bill. Thank you for bringing up that concept, sir. So what happens here is that most companies that are small don't pay dividends because it's usually like maybe one man that own the business or something and all of that, or maybe and so on and so forth. Or even if it's one man can pay himself dividend also as in the company. But I know in Nigeria it's not practiced like that. Most people don't do that. But usually you should pay yourself dividend as the owner of the business to take dividends from the company. So, like Mr. Iman rightly said, before you take your profit to P&L, you have to pay dividend first if you are paying dividends. But it is not compulsory. Dividend is not a compulsion in the according to the accounting standard. It's not compulsory that you pay dividend. That's IAS what? Who can tell me? IAS 33, right? Earning per share and dividends. IAS 33, if I'm correct. So you don't pay. It's not compulsory you pay dividends to the shareholders. You only pay dividends when the company can pay dividends. For example, if you made loss, you can't pay dividends from loss. So and that dividend, that loss you've made, will also go to what? It will go to the retained earnings. Because if your retained earnings before, let me bring up my Excel. If your retained earnings before, if it was let's say 50,000 pounds retained earnings. Let me use a different figure so it doesn't confuse you. We said 30,000 pounds you have retained earnings before, and you made a loss of 10,000 pounds. It will come in here to reduce your 30,000 pounds, right? What you then have is what? What you then have is 20,000 pounds. So if you made profit the following year of let's say 25,000 pounds, it comes again to the retained earnings. Then when you sum it up again, you have what? 45,000. That's how retained earning works. So, but if you then say the following year you made a profit of let's say 20,000, and then you want to pay dividend of 10% of that profit, then you can also equals this. Let's say you're paying 15%, for example, right? 15% of dividend. We then say this minus this, the dividends you paid, then the difference goes to what? Retained earnings. Then you then add it up again. This plus this, right? Is that clear? Then we have this our retained earnings for the year. Is that clear? I don't know if you got that, if everyone got that, what I've done. Have you got what I've done here? Okay, because we are declaring 15% retained earnings here, right? Yeah, sorry, dividends here. Dividends is being declared here. So in that situation, we then take out that. Let me put in negative. No, I've already done that. Let's I put this in plus. I just put this in negative. Put this. Okay, no need self here. So yeah. So then 15% is 3,000 of this amount. Then we take it out of it first from our profit. This is our P&L profit. So don't forget our profits for the year. For the year. So then we then take out dividends, then we then have this as going into this that comes in here. So that's how it works in practically. So Thanks for bringing that up, Mr. Emma. Thanks for that. Listen. So yes, so when is it an accounting estimate? It's an accounting estimate are used when precise measurement is not possible. For example, that depreciation um rate, that depreciation rate that has been changed. Now, for example, depreciation year, sorry, that was changed from what? From 10 years to 20 years. You know, there is no way it will be possible for us to like actually know that okay, we were not sure because when we started using the asset from the day one, we didn't know that that asset would really be able to last that long. You know, we thought like normal standard, we thought that asset would only last for like let's say 10 years. But when we use it, we find like, oh, this asset is actually a good one because we've used for 5 years and realize that this asset can still go longer than 5 years that remains. It's still working effectively well. And we feel like, oh, since it can work well, we can increase the useful life of the asset to like 15 more years or 10 more years. So in that situation, it becomes an accounting estimate, not a policy again, because we've not changed any policy. You only did it based on measurement because you're able to reliably measure that asset that okay, this asset can actually be measured to be like 10 more years after these 5 years we have left. So in that situation, it comes in as an account estimate. You can say examples include bad debt. You know, you can never go back and reevaluate bad debt. Nobody does that anyway, practically. So inventory obsolescence, fair value of assets or liability, useful life of asset. Can you see useful life of asset and depreciation methods? You can see it. Then warranty provisions, they are all accounting estimates. I like you to note those things because they'll form part of my question that we'll be going through. So those things are actually what accounting estimates, fair value of the assets, inventory obsolescence, useful life of the assets and depreciation methods, warranty provisions. They are actually accounting estimate because you can estimate provision. If you're saying that I'm selling goods for you for £50,000 and I can actually estimate that oh, the fact that that same good I sold last year, I didn't give warranty on that good does not mean I have to give it every year or I have to go back and do it. No, I might be giving my warranty saying that okay, because my warranty now, I must say okay, now this year I want to give warranty on this good. I feel like these goods, customers have not been coming to buy them so much because they feel like if they buy them, they get default and they don't get to get warranty on them. I say okay, guys, in 2026 we'll all be giving warranty for these goods which we have. For example, if it's a phone now, an iPhone, for example, we can say we start giving warranty for every iPhone that we produce and we sell to people because people have been complaining a lot that our iPhone does not last more than 1 year before something happens. So therefore, we can say, okay, we'll give warranty for up to 12 months. So when you apply that policy of giving warranty, it is an accounting estimate because you have to start from the date which you say you'll be giving that provision. That day you say you'll be giving that warranty. You have to make a provision from that date, not going back to other people that have bought that you did not make that provision for because you will be shortchanging yourself. So that is how that works on that. So I'll be moving forward. So the disclosure requirements, these are just like normal disclosure you need to disclose because when you have an accounting estimate or accounting policy, you need to disclose. So you must disclose the following. Every company must disclose the following. You must disclose the reasons and financial effects of the accounting policy change. So you must explain in your disclosure notes. I don't want to go and start showing us accounting disclosure for accounting policies. I must have shown you one or two before in the account we did before. So I don't want to start going on to that now. So if you go and check any account, you see every of these notes there, talking about the accounting policies made, the um, the um, the assumption made and all of those things made, they are all accounting estimate and policies. Is always in the disclosures of every account prepared. So you have to disclose the reason and the financial effects of accounting policy changes you've made. You must also talk about the nature and the amount of the estimate changes that affect the current future. For example, you always have what's called current liabilities and non-current liability. So you also have what's called provisions in current liabilities, which are usually what span within 12-month period. So from the date the account is produced, which is December 2025, up to December 2026 is the 12-month period, which will be in current liabilities. While the one that will be non-current liabilities will be from December 2026, from January 2027, sorry, to upward are non-current liabilities, which will be your disclosures, which will be made and you'll be explaining. Let me explain that to you. So if you have a provision of let's say £100,000 obligation, which let's say like that pension I talked about pension, right? Where I had to okay, let me just show you what I'm talking about. Let me pause. So nature of prior period errors and corrections which we've made, which I explained in that account, then the amount will be restated for comparative or explain if impracticable. So most times it is practicable. There's no time you cannot. I've not seen any account that you cannot explain why you where you cannot bring accounting comparative figures. You always show it in the comparative figure following year. As you made the adjustment in this year, you show it in your comparative account to show the figures how they change and explain why you've changed them. That is how that actually works for that. I don't know. Do you have any question? Who has any question for me? Who has any question for me? Do we understand what I've been teaching so far, please? Hello? Hello? Okay. Yes, yes. Okay. So, Mr. Moifed, are you clear? Mr. Upele, are you clear? Okay. So I'm going to go to question and answer now. So I'd like you all to be answering the questions. So before I move to the last thing. So I have a question. When you hear the word define accounting policies with examples, so what do you think? Who can answer that for me? What's an accounting policy? What comes to your mind? Yellow, yeah. Yes, yes, sir. Okay. Who else again has anything to say? Does anybody have anything to add to it? Okay, so Mr. Opel, Mr. This is correct. So accounting policies are policies are rules, principle, and principles such as inventory, valuation, depreciation. Those are accounting policies. So when you word the word accounting policy, you're looking at the word rules and principles. What are the rules and principles that guide these things? And it must be covered by what the IFRS. So that is within the accounting policy. My next question is, when can a change in accounting policy be made? Mr. Opele, when can a change in accounting policy be made? I want to know if you are following me. That's why I'm asking this question. Then I want I'm not answer me this one. Differentiate between retrospect. Oh no. Okay. Differentiate between retrospective and prospective application. That want to try, please. When can a change in accounting policy be made? Mr. Opele, Mr. Opele, are you there? When can a change in accounting policy be made? Yes. Is it a tricky question? Yeah, saying the same thing I'm asking you. Yes, partly. Yes, partly, at least. If it will affect the users, yes. And when it is permitted by the IFRS, yes. If it's permitted by the IFRS and to affect users and to change the level of consumption, then a change in account policy should be made. If we change the level of consumption and to affect the users of the financial statement. So the difference is that it will change the level of consumptions. It is permitted by IFRS and then it will affect the users also. So then a change should be made. So where about Aminat differentiate between retrospective and prospective application? Your voice is low. I think she's still trying to come in. Yeah, I can hear you now. Yeah. Okay, so I'll bring the answer now. So the answer is if required by IFRS for when a change in accounting policy be made. If it's required by the IFRS or results in more reliable or relevant information, like we said, it was required by the IFRS or it will help the users to be more informed. Then retrospective is applying it as if it has always been. Do you get? As if it has always been, like you said, I mean that's correct. Taking it back as if it has always been, then the change has always occurred. Then while prospective is applying from the date that change was made. You, you apply from that date and you move forward from that date. So I'm going to ask more question now. So my next question is entity A changes from first in first out to average cost of capital I say average cost of capital to average weighted or cost model for inventory valuation. That's AVCO, yes. So how is this treated? Is it a change in policy or a change in accounting estimate? Don't forget that I showed you this before when we were doing that. Say note all these things down. Anybody with any contrary opinion? I strongly doubt. Oh, why am I answering the answer? Who else had another thing to say? Anyone want to try again? I tricked you. I mean that I tricked you. The change in accounting policy. You apply retrospective application. Yes, because you have changed. Don't forget you're using first in first out before. Then you now change to maybe like LIFO or weighted average cost of capital. Do you get? Then you have changed your accounting policy because in first out, you are picking goods that come in as they come in first. You are using them. Now you are not changing to your inventory system to maybe last good that came in, or you're using weighted average. You are now weighting them using weights up to 100%. Do you get? If you're using weight, then you've changed the way you've done. So you have to go back and reweight everything from beginning. So that is why it is a change in accounting policy. So the next one is this. Give three examples of accounting estimates. You can give me three examples of accounting estimates. Three examples of accounting estimates. Useful life of asset. Mm-hmm. 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 And what else? Anyone want to try? Okay, so bad debt, useful life of asset, and fair value of assets. That's the answer. So the next one is entity B discovers a prior period error in revenue recognition. How should this be corrected? I've used that as an example. Entity B discovers a prior period errors in revenue recognition. How should this be corrected? Can Sandra answer this for us, please? Well, David, you need to answer the fourth one for us. A change in useful life of a machinery or course. Is this a change in policy or estimate? Change in useful life. The key word there is useful life of the asset. The useful life of the asset has changed from maybe 10 years to 15 years or 5 years to 20 years. So, David, what's the answer for that? Then, while Sandra, entity B discovers the prior period errors occurred in revenue recognition, how should this be corrected? Are you there, please? Okay, so Sandra thinks it's a change in accounting, um, a change in accounting estimate. So, David, what about you? David, what about you? For a change in useful life of machinery or course, is this a change in policy or estimate? Okay, that's correct. So, but however, Sandra's one is this thing is policy, is not estimate. Because don't forget, I use an example for you very well. I said that when you sold a good to someone at the end of the year, and the goods went on ship, and then they returned the goods saying that no, they don't want that good. Don't forget that goods to you is a sales in your P&L, which has closed as in the 12 months as you end your book and close your book, P&L closes. Then you've moved the profit you made in that year to retain earnings. Don't forget. But in the person that you sold it to, in their own book, is an inventory. But then they say that they don't want this inventory, that because this inventory came in late, they return it back to you. So because they return it back to you and you have already recognized that income last year, you have to retrospectively go back. This happened to me, one of the clients I worked on. Oh. You have to retrospectively go back and go and adjust that profit you made. So you have to look at the element of the what, of the cost of that goods you brought. So you have to go back and do what, debit what. Let's do the account. Let's do the posting. Don't mind my like posting. So now you sold the good for 20,000, right? Right. Then it is in sales, your sales, right? Then your cost for that good you sold, eh, is what? Let's say 10,000. 10,000. Hmm? So then what you then need to do is this. You have 10,000 gross profits. It's form part of the gross profit you made in that year. So what you need to do is you need to then do and go. What? Don't forget if you've created this before. You don't go and say debit sales. Now, if before, normally you created sales, right? You have to debit sales and what? Credit what? Why are you crediting? Tell me what I'm crediting. Accounting guys, tell me please. Let's do it fast. What am I crediting? Oh yeah, you guys should be giving me accounting entry quick now. No, thank you very much. Debtors, receivables. So you credit receivable. Don't forget that when you sold the book, this is what you did. You did credit sales. Don't forget, right? Eh? And you debited what receivables, right? Is that not what you did when you bought the goods? That you sold the goods. That's what you did now when you sold the goods. Don't forget that receivables is a balance sheet item, so it will always remain there, right? It will always remain in your receivables. Balance sheet item will always be there. So you have no problem with that. So just know that. So your receivables remain your receivables. So you're just going to reverse that transaction back. It's going to now be reversal of return goods. That will be in receivables. What the one in the sales will be reversal of what? Goods sold. Then your cost of sales too. You have to go back and reverse it. You now do what? You now do credit what? Cost of sales, right? And debit what? Why are you debiting? Tell me where you're debiting, please. Oh, yeah, accountant, let's do it. Inventory. Thank you very much. Debit inventory. Exactly. Then we are good to go. If you do all of this, then this profit you made here will be what? It should not exist again, typically. Because if you've done debit inventory and done this, it should have, then you move the difference of this 10k. You move this 10k to what? Retain earnings. So it will be what? It will be what? To be debiting retain earnings, right? Or is it credit? Is it credit retain earnings? Is credit or debit? Tell me, what's it? I thought you were going to fall for it. Debit retain earnings, right? And what are we creating? What are we creating? Create what? Hmm? Yes, because our sales already, don't forget, our sales already has taken care of that already. Sure you get? Do you get? Do you understand now? Because don't forget our sales has taken care of that. So let me do the accounting entry once and for all so we don't mess about this. So let's just take it straight. We just say debit what? Don't forget, we know we cannot debit sales again. I'm just showing you what we should have done normally. Now we'll be debiting what? Retain earnings, right? Eh? And then crediting what? Cost of goods sold, right? Crediting what? Why are we crediting yet? Why are we crediting here? Whoever gets it, I'm going to give the person £10 voucher. Why are we crediting there? Whoever gets that, I'm sure nobody will get it. Why are we getting there? I'm 100% sure nobody will get it. Inventory. Who else want to try? Who else want to try? If you get it, I'll give you £20 voucher. I know £10 voucher. Let me not go and risk it. Who think Paul? Who wants to get it? Who wants to try? Who wants to try accounting entry? Oh yeah, oh yeah, oh yeah, oh yeah. Don't use ChatGPT. Tell me quickly. Use ChatGPT to get it wrong, so don't worry. Just who wants to try? My voucher is going, going, going. Sandra, try. I'm not try. Because I'm confusing you guys. You are going to create retained earnings too. I'm confusing you guys. Yes. Don't forget. Don't forget what we are doing. I'm not. Do you get the logic of what I'm doing here? Eh? See, these two things will give you 10,000 that you have here. Debit retained earnings. Does it make sense to you? No. Credits what? That's correct. Does it make sense to you? Eh? Let me explain to you. Let me break it down, right? Hmm? Should I break it down? Hmm? Okay, this is what happened here. So now don't forget when we sold our goods. Eh? We did credit income, debit receivables, right? Initially, right? Eh? Now, because the goods was returned back to us and we've closed our book. Normally, if we've not closed our book, what we'll be doing is debit income, credit receivables, debit cost of sales, credit inventory. Sorry, credit cost of sales, debit inventory, right? But because our book has been closed, we cannot do that again. So we are doing what is called the retrospective application. And don't forget that because our book has been closed, we have to be eating what? We have to be eating receivables. We have to only eat everything in balance sheet. Sorry, not receivables. Retain earnings. We have to only look at everything in balance sheet alone and nothing in P&L again because that account has been closed. So what do? We then do debit what? Retain earnings. Instead, I'm just showing you this as breakdown. Normally, what I'll just do is I'll just take off the costs away. It's 10,000 that is different. I'll just take this 10,000. I'll just do debit retain earnings, right? As my this thing. Then maybe credit what's it called? Receivables. Do you get? Because it is like debit retain earnings, credit receivables, right? The credit what? Retain earnings, debit inventory, and that balances our account for us. Do you get? Sandra, are you clear with this or it doesn't still make sense? Hmm? Hello? Does it not is it not clear? I can break it for that if it's not clear. Eh? No, are you sure? Tell me what you understand. Explain what you understand to me. Explain it to me. Don't tell me, don't just say it's fine. Tell me what you understand. Tell me what you understand now. Yes, exactly. So exactly. Don't forget that everything I'm doing here is just to confuse you. It's the same thing. Don't forget that everything I'm doing here is balance sheets. It's P and L. Sure you get this line is meant to be debit income, credit cost, isn't it? Hmm? Debit income, credit cost. That's what I should have done. But because P&L has been closed, I cannot do P&L. P&L, I can't touch P&L again for that year. It's been closed. So all I need to do is just eat retain earnings straight with this. And then it's my normal asset posting. And we are good to go. Because I have to return back my credit. Because before, when I sold the goods, I debited receivables. I have to reverse receivables back. Now call it reversals of what? um goods sold returned. It's going to be a credit note, right, to receivables. Then why inventory to have what a reversal of our inventory back? Because don't forget we got that goods back, so it's going back to our stock as inventory. So we have to debit inventory back because we've already created inventory where we sold that goods. Don't forget, so we have to debit it back and put it back the way it was. The receivables has to also what be what we have to also what credit receivables back again. And then we have to use all of this to treat anything P and L. Let's go to retain earnings straight. That's a shortcut. Anything P and L, go to retain earnings or straightways. Right. Is that okay? Is that all right? All right. So the next question. Entity B omitted 20,000 revenue in 2022. What will you do? Is it prospective or retrospective? Entity B omitted 20,000. I'm not. I've explained that thing. No, you are not in class. Let me just quickly go back and explain it. Are you here now? Okay. So what I've done is this: is that, and don't forget that when we saw this goods, I'm not. What we did was this. Let me take this away. You remember when you sell, you do what? Credit what? Sales, right? eh? And debit what? Receivables, right? Eh? Then when you do cost of sale, you do what? You debit cost of sales, right? Am I correct? Yes, debit cost of sales. Debit cost of sales. Then you credit what? You credit what? Inventory, right? Eh? So because they returned that goods to us and they don't want that goods again, and we've closed our book for the year in P and L. Balance sheet is at balance sheet is at a point in time, right? While P and L is at the period in time. So it means P and L has been closed for that 12-month period. We cannot do anything again. So everything here we are reversing now. Normally we should be reversing like saying debit sales, right? And credit cost of sales, right? Normally, if the book was still open, right? Hmm? But because the book was closed, we cannot do that again. So we have to now be doing instead of saying debit sales, credit cost of sales, we now be doing debit retained earnings, eh, and credit what retained earnings again. Then I'm going to show you what I'm talking about here. Now, instead of me, when we first sold the goods, we debited what receivables by saying that we are expecting cash, right? And when we then sold the goods, we reduce our inventory by creating inventory, right? Now we have to do the reversal of what we've done. We then do credit receivables and debit inventory. So I look at the accounting entry. We say debit what retained earnings, which is our sales. Then credit receivables. Then credit retained earnings again and debit inventory. What I've just done there is just being stupid. I've just said what I've done is debit sales, credit cost of sales. That's what I've done. But because we cannot touch that account again, it has to go to retain earnings. Because don't forget our profit for the year are going to retain earnings. But the profit we made on this item in this year is £10,000. Do you know? So by the time you look at the difference of this, it goes to retain earnings. So what I just do basically is just saying in normal English is just to say £10,000. Don't forget that is what? That is this what? Right? £10,000, isn't it? I just say what? I just say what? Debit what? Eh? Debit what? Retained earnings. Is that correct? That's what I should have done once. But I just want to break it down for you to know. That's why I'm doing all of those, doing debit and credit. And after doing that, then I'll now say, okay, then 20K, 20K will now be credit what? I'll now say credit what? 20,000. Sorry, I'm coming now. I say 20,000, I'll say credit what? Um, credit receivables. Sorry, how am I difficult to write? See, receivables, right? And then what? 10,000 debits what? This is what you're going to post when you're doing what's it called, ACCA or anything. No, people that do ACCA. This is the accounting entry we should have posted. I don't know if this is clear to us. Hmm? I'm not. Do you understand this accounting entry now that I've posted? So instead of me doing this, I've just done this to break it down further. Do you know it's the same thing I've done year and year? Do you know? Do you agree? It's the same thing I've done year and year. They're the same thing. Do you agree? Oh, really? But I thought this one should even be easier to me. That's why I feel you guys should know because I've done. Okay, so debit retain earnings, and which is P and S side that I've taken to balance sheet already. So debit that's credit receivables, credit is debit receivables. So you see the same thing. Net difference is going to be 10,000 difference, which is this. So just debit is straight shortcut, 20,000 to receivables and then 10,000 to inventory. This is exactly a question that you'll be doing when you're doing group. You must do something like this in your group account in ACCA. You must do something like in your group account. So that is just that. So I believe we are all clear with that. So yeah, entity B omitted £20,000 in revenue in 2022. Is it a prospective or retrospective application? Anyone want to attempt? What is the accounting adjustment to use? Who can help? Accounting adjustment. Anyone want to try? Retain earning and inventory. All right, let's look at the answer. So, correction will be in 2023. So, it is a retrospective statement required. Adjustments, we are adjusting the opening balance, opening retained earnings in 2023. So, I'm not Mr. Opele, you are correct. So, the same thing, debit what trade receivables with 20,000 and then credit what retained earnings with what? 20,000. So because that sales was omitted, don't forget it was omitted. Do you get? Which means they never posted that sales at all. Do you get why I'm doing this? This is different from the one I showed you before. You know the one before was returned. Sure you get? That was returned goods. This one they omitted, they didn't post it at all. So what they we need to do is do normally if they had posted, they would have done credit income, debit receivables, right? But they did not post that sales. So then we have to now take it to retain them because income has been closed. The book has been closed. So we need to now do credit retain earnings 20,000 and debit receivable 20,000. So comparative figures for 2022 are now also restated. Is this clear? Is this clear with us, please? Yes, because 2022 figures when you put the figure on your on your P and L, don't forget that you must have, let me show you. Yeah, let me show you let me show you what would have happened. 2022, 2023 sales they'll have had, let's say, 30,000. 2023 sales is 60,000. Comparative analytical review is equals to what? Equals current divided by old minus 1. That's increased by, let me just put 50%, 50,000 here, 55,000. That's 83%, right? Lock it in percentage, 83%, right? Is what it has increased by. I'm not like, how come? How is 2020? You know, when you're not looking at comparative rate, I said, how come 2023 is higher than 2022 by 83%? Do you get? You start asking this question that why is this like this? You know, it doesn't make sense. Then, but because they've omitted the sales, then you can easily know. So for comparison, you now have to say omitted sales, right? Will not come and say what? 20,000. Hmm? But yeah, there is none, right? We now have to say total is what? Comparative purpose. Sorry, why am I done here? Control C, Control V. So we're not going to do copy and paste. Can you see it? Does it make sense now? Hmm? Does it make sense now? Hmm? Is that clear? Eh? Because now I've brought in the omitted sales now. So comparative figures now look make sense. Sales increased by 10%, which makes sense. You can't tell me that a sales in a company increased by 83%. It does not make sense. Are you saying that last year you suddenly just won a jackpot this year and your sales jump up by 83%? I've not seen that before. Usually sales increase by 10, 20%, 30%, not 83%. So we know something was wrong there. So we have to restate that thing there, saying omitted sales. So which we brought in here. For comparative purpose, we brought it here. But however, this is not in the P&L. It's going to retain earnings already. Do you get? So that is what has happened here. So credit retain earnings, which is the same thing as the sales. Then debit was trade receivables. So that figure will have also gone to retain earnings. Don't forget that retain earnings will also have it there in your 2023. Do you get what I mean? 2023 we have it in retained earnings in the balance sheet side of it. So, and that sorts that out. Is it, have I missed a question? Okay. So, next question. So, entity A changes its inventory method from FIFO to AVCO. FIFO closing inventory in 2023 is 120,000 pounds. Then AVCO closing inventory 2023 is what? 110,000 pounds. So, how would you treat this? Mr. Who can I ask? Oh, Mr. Omoefe. FIFO closing inventory 2023 is 120,000 pounds, but AFCO closing inventory 2023 is 120,000 is 110,000. But the entity changes its inventory method. Don't forget the word you're looking at. Change of inventory method from FIFO to closing. What has happened there? Is it retrospective or prospective? That's the first thing you need to look out for. Is it change in accounting policy or estimates? If it's a policy, it's retrospective. If it's estimate, it's prospective, right? Then if it is changing, if you think it's prospective, then how would you treat it? You know, if before in closing 2023 was 120, they change it, then does it need to make any adjustment or not? Avco closing in 2023 is 110. Was there any adjustment that needs to be done? So that's the answer I need. So Mr. Amo, if you can you answer me, please? Anyone that wants to help him out? Anyone? Anybody? £50 voucher. Going, going, going. No, 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 not trying. I'm reading the answer. So, so right, it's a retrospective adjustment. So because they've changed their inventory policy from FIFO to AFCO. Don't want to forget I mentioned that in this. I said that when you change from FIFO to weighted average, that they are changing policy because you have to now go and say, okay, you were using first in first out before, now you're now using what's called weighted average cost of capital or maybe AFCO. Then you need to apply it retrospectively as if it has always been. So the difference here is £10,000, which is a decrease in inventory because if you see in 2023, the FIFO is 120,000, but now in 2023, they've now used the closing balance of inventory because they changed from FIFO to AFCO. So the AFCO now is now what's 110,000. So then what we have to do, you have to apply the retrospective application to reduce the opening balance of retained earnings by 10,000. So the journal will now be what? Debit retained earnings 10,000 and credit inventory of 10,000. I don't know if that makes sense. Does it make sense? Does it make sense? Hmm? Hello? Are we there or are we lost? Hmm? Okay. Don't worry, this is not IFRS. IFRS 15 is simple. When you start doing when you start looking at all this retrospective thing, they are confusing to be fair. Even to me, they are always confusing to me too sometimes. So when we go into deep accounting this thing, it's always looking much more a bit, but it's not like it's difficult. You just need to understand the concept of prospective and retrospective application. When is it prospective? Like I explained, if I go back to all of my example, you know, I talked about when it is what, when it is prospective and when it is retrospective. You can say, I said when it is an accounting estimate. Accounting estimate is what? Is it prospective or retrospective? Accounting estimate. What is it, Mr. Moefe? Accounting estimate, is it prospective or retrospective? Thank you very much. Which means accounting policy is retrospective. So when you see example is bad debt, inventory obsolete, fair value of assets, useful life of assets, warranty provision, they are all accounting estimates. Then if you are looking at things like, can you see accounting policy, FIFO, weighted average or AFCO? Can you see exactly as example I gave you is what I've given you, and I'll give you back again as question. Those are changing accounting policy. When you change from FIFO, when you change the year, depreciation method from straight line to using balance, you get those are normal accounting policy. So that is just the example I've given. So now the last question I want to ask is this. So machine costs. Machine costs 50,000. This question is to Mr. Upele. Machine costs 50,000. Useful life is 10 years. Straight line, no residual value. After 3 years, revised total useful life equals 8 years. Then 5 years remaining. What kind of thing? Is it a change in accounting policy or change in accounting estimate? Very easy. Anybody? Any other person want to try? I don't believe what he said. Any other person wants to try? I'm, I didn't say I'm giving voucher for this. So yes, so it's an accounting estimate. You're applying what is called a prospective application of the asset because originally 50,000 divided by 10 is 5 years, right? Like my example I gave you. Accumulated depreciation for 3 years equals 15,000. Carrying amount is 35,000. Revised depreciation is 35,000 divided by 5, it gives 7,000 per year. So which is applied prospectively from year 4 onward. So that is a prospective application of it. So another question which I have is this. Entity C sold goods worth 100,000 with 2 years warranty. Expected cost equals 2% of sales. Is it a prospective or retrospective application? I want Sandra to answer this, please. Sandra, entity C sold goods worth 100,000 with 2 year warranty. Expected cost equals 2% of sales. So do we apply this retrospectively or prospectively? Hmm? I just mentioned this now. I mentioned this now, and I've even mentioned it very well. Is it going to be two? Is it going to be retrospective or prospective? Why? I don't believe that. I'm not, please bail out. I'm not, please bail out. I'm not, please bail out. Is it prospective or retrospective? Ah, you two, you are saying something else. So Awupele, please. Awupele, so Omoefe, please. And you guys are just saying your own. Okay, so you guys got it right. So provision required is what? Is a prospective. Don't forget I talked about it. That's prospective. Warranty is futuristic. So all it out times 2% is 2,000, which is the warranty. So they cannot take that warranty. It has to go debit expense 2,000 and credit warranty provision, which is going to be a liability for them, right? In that year, and it is applied prospectively going forward. So that is the end of this class. I can't take another. I was going to take. No, let me just quickly take that. Please, I already have. It's a very short standard IS 24 related party. It's not long at all. Please, let me just take it within the short time I have. I can quickly take IS 24. It's not this thing. It's a very short standard. It's not long at all. So I'll take IS 24. IS 24 is talking. Eh? Yes, IS 24 is related party disclosure. So it's talking about how you disclose related party transactions that you have with people who are close to you. So I'll just run through it. It's very straightforward. So introduction to IS 24, it defines when parties are considered related parties, ensures transparency in financial reporting, prevents misleading assumptions of independence, requires disclosure even if transactions are at market value, which is at arm's length. That's the word. If it's done at arm's length, or even if none occurred, you need to disclose. In the UK, when you have related party transaction, you have to report. You have to always put in your account all related party transaction that you ever sold, or the people that are related to you that used to buy from you. You have to disclose them. You have to give us the books of all their names and who they are and how they relate to you. Very important. Even if they occur or not, can you see? Even if none occurred, you need to disclose because they've been buying from you before. You need to always disclose them. So, when do we say a person is a related person? How do we classify someone as being related? So, according to IAS 24, a person or close family member is related if they, one, have control of the company or the business. If you have are operating as a joint business together, you both have joint control, then then they are related to you, or they can significantly influence decision you made. For example, if they have 75% shares or 51% shares in a company, anyone who has 51% share in any company, 51% can control the company, technically in line with IFRS 10, which is control. Although we were made to understand that even though you might have 51%, you might still be a dummy and not be able to control your company. But technically, 51% should be able to control a company. So if you have significant influence in a company, then you are a related person. Also, if you are a member of key management personnel, for example, if Aminat is my family member, and I'm the manager of Coca-Cola, then Aminat is buying something from us, then she is a related party to me. I have to disclose it. If a key management personnel of the entity or its parents. So Aminat, for example, now Sandra might be a friend Sandra might be a friend to, let's say, Mr. Ima, and then Mr. Ima is the MD of the company, and I am the group MD of the group company, and Mr. Ima knows me, and but Sandra is now buying something from us as the group. I have to disclose it because Sandra knows Mr. Ima, Mr. Ima which knows me, so we can influence decision and make transactions that in the company. So she's a related party person to us. That is how it works. So when an entity is related, how do we know that they are related? What are the circumstances that we will look out for when they are related. We look at the entities in the same group. Are they in the same group? For example, if company A owns company B and company B owns company C, they are related companies. If I own Omoefe and Co. and Omoefe own Aminat Lawa and Co. and Aminat Lawa owns Sandra and Co. Then all of us were all related companies. We are all related entities. So one entity is an associate or joint venture of the other. If they are related as associates or joint venture of the other, then we are related entities. If both entities are joint ventures of the same third party, which for example, if company A owns company B, but company B owns company D, and company D owns company C, then company C is a related company to company A. Do you get what I mean? If company A, if Sandra own Mr. Moefe. If Mr. Moefe owns Aminat, but does not own Oupele, if Sandra owns Mr. Moefe, listen to this. So if Sandra owns Mr. Moefe as a company, and Mr. Moefe then owns Aminat, right? But does not own Mr. Opele. But if Mr. Opele now own if Mr. Upele now own Sandra, who is the top, then we can all say we are all related. Or let's say I'm not looking for we are just let's say okay, if Sandra owns Mr. Moefe, and Mr. Moefe now owns Adejoke, and Adejoke now does not Adejoke now owns what? Adejoke now owns Aminat. Then Musa Pele now owns Adejoke. In that situation, they are all related entities. Even if they don't go straight ways, even if they go zigzag anyway, they're all related companies because they both own one shares or the other as in each other as an associate. And let me define what an associate is. I forgot to mention. An associate according to IS 28 is defined as a person who has what 20% up to 20% of his shares in a company in line with IS 28. I'm just giving it on top of my head. Sorry. Is a person who has what up to 20% of a business. Don't worry, this will be taken by Mr. Badru, the Lord of Tax and the Lord of IFRS. He's going to come and take us on IFRS. He's very, very good, Mr. Badru. So he will be taking us on group accounts and disclosures. He's very, very good. He's a Lord, he's a master. So one if an associate according to IS 28 is someone that owns what 20% of what? I hope I'm not bombarding you guys, so because I'm saying everything from my head though. I'm speaking. I might be very fast though. Sorry. Oh. Are you guys still following me? Or you are lost. Okay. So okay. Okay. I want to ask the people who are not qualified. Sorry. Oh, I'm not trying to insult you, but these are qualified people, so you have to respect them. So Mr. Opele and Mr. Moefe, you need to be respecting Sandra and Aminato. Because it's not easy to bear that name ACA after they are bearing the name ACA at the back of their name. So that name, they suffered for that name. Oh. You know the textbook they read, big textbook they read. So 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 it is well. So like I was saying, an associate according to IS 28 is let me just drop it in chat. IS 28 associate owns 20% in shares. So they are classed as what? Investors, right? They are just investors, isn't it? I'm not. They're just investors. They are not owner of the company. Why? The joint ventures, according to IS 28, a joint venture is someone that has 50% of the company, 50% of shares, right? Am I correct? I'm saying this from my head though, of a company. I believe I'm correct. Of a company, according to IS 28, it's still under IS 28. While so they are all under related party entities because they are both related to each other. So both entities are joint ventures in the same entity. Entities controlled by related party. So now IFRS 10, IFRS 10, which is talking about control. Am I correct? Control, yes. So whether it's controlled by control many companies, is still what? That's our 51% shares, right? 51% plus shares is a related party with its what? Its subsidiaries. So entity is controlled by a related party. So they are all related parties because they are like a conglomerate. They have different entities. So if a person has 20% of shares and the person is referred to an investor, does not mean you are not related to that company. So that alone gives what is called vested interest in the company. So, and we have to now do a test to be sure that okay, are the transactions done at arm's length or not? So, let me go with my slide. So, yes, okay. So, why disclosure is important? So, now, why all of this is we are talking about that we are talking about related party transactions and this and that occurring. Why are we talking about them? It is because we want the users of the financial statement to be sure of the following: that one, that transactions are done at arm's length. We want to be sure that transactions are done fairly because you can use related party transaction to defraud the government for tax. Am I correct? Do we all agree that we can defraud the government for tax using related party transaction? Because there's what we call, there's a word I want you guys to give me. I don't want to mention the word. There's a very important word they use: transfer pricing, isn't it? When you transfer something from one entity to another, let's say you move items from, let's say, Opele and Co to Sandra and Co, which is your subsidiary. You can decide to sell that item that you produce in Opele and Co, sell it to Sandra for, let's say, £2. That item might be worth £10, but you sold it to Sandra at £2 because you know that if you sell it for Sandra at £2, you can easily say, okay, you didn't sell it for high amounts, you sold it for small amounts, right? And then you will not be declaring so much tax. But however, at the backyard, you know in your mind that you are collecting money from Sandra as a form of group recharge, isn't it? Or not be subject to any tax. So that is why you need to also, you can decide to sell goods to Sandra at a very high price. You can sell goods to Sandra if you are working in different countries. If you are maybe in UK and where the tax is high, and you are in Nigeria, Sandra is in Nigeria where the tax is low. You can start to say, okay, Sandra in Nigeria, please, I'm selling this good to you at £100,000. Sure, you get. So what am I saying? Yes, someone who is in Nigeria will want to sell to someone in the UK, right? At a high price. Is that correct? Let me think about it properly. Because if you sell to someone in the UK at high price, because the tax is high here, they can have high cost. Yes, yes. So if Sandra is in Nigeria and Opele is in the UK, Sandra can start to sell goods to Opele at high price. If that goods is cost, let's say, £10,000, Sandra can sell it to Mr. Opele at what? At £20,000. Because they know that in Nigeria that the tax laws are not so rigid, which means you can start to go away scot-free when you default on tax and when you evade tax. So they know that, oh, in Nigeria we can easily settle that out. So we can easily sell. It's not rigid anything. It's not rigid anything. I know all those things. It's still child's play. Leave that in. It's child's play. No be Nigeria, we will know. Forget. So then the okay, okay, okay. Agreed. I know Aminat is in tax, so she's willing to support her people. Agreed. And it's her uncle that is the one doing that tax reform. So I agree. So So now someone in Nigeria might be willing to sell item at very expensive price to someone in the UK. Knowing that when it comes to the UK, they already have a cost. No, a UK company will be having the cost because in Nigeria is a sales, right? Which are supposed to be taxed, they'll be taxed for in Nigerian law. But in the UK, it's going to be a cost to the UK company. So if it's a cost to the UK company will then have to sell that inventory. If it becomes inventory to them, they sell their inventory at what? Let's say you already bought for £20,000, you can sell for £21,000, and then you end up making 1,000 profit. By the time you remove administrative expense, salary, and all that, you end up making loss. And when you are making loss, what happens? You cannot pay tax to UK government. But whereas in Nigeria, the company has sold at more than that price to the UK company just to avoid that tax. Because normally if they sold for £10,000, which it is worth, they would have paid they would have sold for £21,000 and made 11,000 profit. You get the logic in UK, but they try to reduce that tax from Nigeria, and then Nigeria they will put that money to one offshore company or something that then they've evaded tax in a clean way that no one sees it. And Nigeria, definitely we trust Nigeria. We understand what's happening there. So that is how you can actually distort stuff. So that is why it is important to disclose your related parties because of the purpose of that. of transactions should be done at arm's length, right? It has to be done at arm's length, as if it is done at normal market value, as if I don't even know you. That's how I'm selling to you. So why disclosure is important? Without disclosure, users assume independence. They just assume they can do what they like. So transactions will not also be at arm's length. Then also related party transactions may distort performance because they'll just be using it to distort performance. They just see someone just say, Oga, you see someone from maybe company B, let's say someone in Sandra and Co. and David and Co. David just say, Sandra, I'm making loss, so I'm not eating performance. So Sandra said, don't worry, I'll help you. David, you're my boyfriend. You just say, okay, so what I'll do is that David, I will supply you this so item and supply you, then you say that your profit, your income will go up. So Sandra will supply David that item. They'll put in their book. After David meets his performance, David will send it back to Sandra back to as a call as a sales to Sandra, or return or refund that we don't need these goods in our book. Whereas that has already was it has done what it has distorted what that distorted performance, because performance is no longer real. I don't know if you get the examples I'm giving you. I don't know if they make sense, because performance are no longer real, because you've already gone to say, oh, please help me to meet my performance, help me to meet my target, so I can get bonus, I can get profit share. So other companies can be helping you, which are related companies. They can be helping you to buy stuff from you that they don't need, buy from you, you to you sell to them. You guys are just forging performance in the companies, in the group, forging performance. The company, the group is paying you guys for not meeting any performance. You are just forging it within yourself. So disclosure helps users to assess sustainability results, because these people who are using these things are what? Are end users, who are shareholders, public. But when you disclose all the goods you've sold, I'm like, come look at it. Oh, how can David sell to Sandra? And Sandra then sold back to him, to her again. And they are saying they made profit of so and so. These are just goods sold at this company. So those things are being disclosed. And it gets very difficult for you to just hide under anything. So common misunderstandings that people have about IS 24 is that disclosure required even if transactions are at market terms. So disclosures are required even if transactions are at market terms. You need to disclose. Some people think that, oh, because you did not sell at because you sold at market terms, oh, we sold at arm's length, we don't need to disclose. But no, you have to still disclose. Whether you sold at arm's length or not, you must disclose in line with IAS 24. You must disclose. So example is parent direct subsidiaries to purchase from one entity. You know, if a parent say buy from this entity, even if they buy from them, you still have to disclose. You get, if the entity is sold, future results may differ significantly. So let me just go to the next one. Always disclose parent entity. Disclosure required even without transaction, like I mentioned before. Even when there are no transaction, you must disclose your related companies, related transaction, related parties you have. They must put their interest out. A subsidiary may benefit from group reputation, management, or credit ratings. Users need to understand group influences. So these are the reasons why you need to disclose your related transactions. So I'm going to ask a question now. Now, Mr. A, do you understand it clearly to that point? I feel it's straightforward. Are we clear to that point? Are we clear? Hello, are we there? Are we clear? Hello, Mr. Moefe, Mr. Opele, are we clear? Okay, all right. Okay. So, but you can see that it's a very simple standard. It's sure they don't usually test it in ACC or ICANN. They don't usually test it too much. They just test it once in a while because it is very straightforward and simple. It just identify related party transaction. That's all. So that's why I just took it quickly. That it took it in 15 minutes without wasting time. So just answer the questions. So Mr. A owns 60% of entity X, and I'll give you an example. And 25% of entity Y. Are X and Y related? Yes, both entities are under significant influence control of the same person. Don't forget, A owns 60% of entity X and 25% of Y. So he owns both X and Y. So therefore, X and Y are related. Even though X and Y does not deal with themselves, they all answer to A. But because X and Y are owned by A, therefore they are all related to A, and the X and Y related to themselves. So that is how that goes. I don't know if that is clear to us. So I'm going to ask us the next question. A parent instructs the subsidiaries to buy insurance from one subsidiary at market terms. Should this be disclosed? I need the answer, please. A parent instructs its subsidiary to buy insurance from one subsidiary at market terms. Should this be disclosed? Yes, because they are related party transaction, even at market value or market terms, so they should be disclosed. So my next question is this: Entity Z, a subsidiary of entity P, benefits from P's reputation. No transaction occurred. Should this relationship be disclosed? And entity Z, a subsidiary of entity P, benefits from P's reputation. Although there were no transactions that occurred, but should this still be disclosed? Everyone agrees with yes. Everyone agrees with yes. Who else agrees with yes? Are you sure? Huh. Okay. Oh. Huh. Hey, hey. Are you sure? Okay. Yes, that's correct. Parent relationship must always be disclosed in transactions. So the next question is this: is that entity A, entity A and entity. Oh shit. Ah, the answer already came up now. I pressed it in error. Do I need to ask the question? Eh? Entity A and entity B are joint ventures of entity C. Are A and B related? Don't forget they are joint ventures, though. They are not just the hand. So you need to now look at this. So don't just say yes, yes, yes. Entity A and entity B are joint ventures of entity C. Are A and B related to C? David, please answer. Um, Omoife, please, Mr. Omoife, please, are you there? Okay, because you guys have seen the answer before now. Yes, both joint ventures are the same third party. So the next question, okay, that is all for that. So thank you very much. That is all for the class. Can say I was able to deliver this in 2 hours. Yeah, able to run in 2 hours just to deliver this. So do you have any question in respect to related party transactions or anything? Let me stop the video.